Hi, I'm Adam Anderson, owner and founder of WealthGuard Advisors.
Hello, I'm Blake.
Hey, we may or may not have interest in you buying or selling the stocks we're talking about today, so read the disclosures carefully. Also, past performance is not a guarantee of future results. Today, we are talking about a common question that I'm getting from clients these days, and that is the market is at all-time highs. Should I be getting out? So, what we wanted to do today is kind of talk about where the market is heading and what the signals are that we look for to start selling, in case that's a question that you're looking at. All right, so I am going to bring up a chart here, share the screen, and let's talk about screen one, the S&P 500.
Yeah, so with this S&P 500, we're looking at 3 years and looking at this trend it's been following. And we see it's very much on trend in the center of the line here. And the reason we're looking at 3 years is because when we tend to follow bull bear markets, it tends to follow along with Federal Reserve policy regimes. So basically, since the end of 2022, when they decided to stop hiking interest rates due to inflation, we've been in this trend for the last 3 years. Um, and so when we're talking about, hey, is this changing? One of the things we look at is policy changes, monetary policy changes that might shift the direction of the market, which is not something we're seeing yet. If anything, them starting to lower interest rates should provide more support to the market continuing to go up.
So, a famous investor, Marty Swag, is known as saying, "Don't fight the Fed." So, if interest rates are going up, that's time when you be more cautious. When interest rates are coming down, which we're seeing right now, it's a time to be more invested because lower interest rates means that businesses could borrow money for cheaper, means that they could grow their businesses faster, means that people could buy things for their home and other cars and such for a lower price. They're more likely to spend money because borrowing is cheaper. Buying homes, hopefully, we're still sitting on a lot of people with low interest rate mortgages, so homes haven't really gotten off the mark yet, but we're hoping that happens. So don't fight the Fed. So we are seeing it in this channel. What we look for is distribution days. So if we see a sell-off day followed by a sell-off day within the next couple days, that would be a sign of like here's kind of a distribution day here and here. But we're looking for about six of them and consecutively over like 25-day period, a month. So that's kind of what I look for as far as distribution days. So far, sorry, that was the market close, 1 o'clock. So that's what we're looking for on that. And right now with the NASDAQ, we don't even have distribution days. It's just been going up. And we have about five on the S&P 500. But I'm going to bring it down to a 6-month chart so we can look at it a little closer. I'm going to remove that drawing and come back to the 6-month chart. And so we saw a downturn just right about 2 weeks ago. And what we've seen is whenever we have a downturn, it seems like the market, the money comes in. There's a lot of money coming into this market right now. People want to get invested. So whenever there's a downturn, it seems like people pile in and brings the market up again. So right now, we're not super concerned. We are concerned. We are seeing highs, but the earnings that are coming in from companies seem to be justifying the price on their stocks. So we're not panicking yet. We're not selling off yet. So I want to bring up another chart that Blake and I have been working on. I should say Blake's been working on, but let's look at this one here. Um, all right. So this is a chart that Blake put together. Blake, you want to explain what's going on here?
Yeah, so this is data taken from the Federal Reserve Economic Data website, and this is charting the NASDAQ Composite Index um, over two different time frames. So in the blue chart, we have from the initial offering of Netscape, which really launched the whole dot-com boom in the
Yep,
late
remember Netscape? That was before AOL, the first internet search engine.
Exactly. And then in the red is following a similar trajectory, but from the launch of OpenAI,
Or
specifically.
ChatGPT. as you'd like
their
to call
ChatGPT model
it. Mhm.
when that originally released. And we see that they do follow pretty much in line here. And so we hear a lot of talk comparisons about, oh, the AI bubble, and it's going to be another .com, where all these tech companies are way overvalued. And so it's a worthwhile comparison here. But really, where we're at is in most similar to basically 1997. And we see another whole 3 years after that until the dot-com bubble burst. So even if companies are becoming overvalued, and I think there is some of that in the market, overall, I wouldn't be surprised to see this bubble continue to grow for another year, 2 year, 3 years before we see a bust in AI. Um,
So I want to be clear. It doesn't mean that we're not going to see downturns along this period of time. Yes, there's going to be down days, maybe down weeks, but the overall trajectory of the market is upward. Now, this is hypothetical. We're looking at what's potential. This is what's happened in the past. So past performance is no guarantee of future results, but this is the potential. So people, I was in the I was in the business back in these days. I remember these days, and I have a quick story for you, Blake. And I may have told you this before, but maybe our listeners haven't heard it. But uh, in the beginning of 2000, I had a lady that I worked for, and I had reallocated her to bonds. She had a 60% stock, 40% bonds portfolio. And she came in and she was mad at me for having bonds in the portfolio. Why am I not fully invested in the market? I could be doing much better. Well, you want, in case there's a downturn, you want to have some protection, et cetera, et cetera. And so she's quite upset about this. So that to me is a signal that we've hit the top. When someone that doesn't belong in the stock market comes in and is mad at you for not being in the stock market. So when I have my clients call me and they say, I want to get out of the market, or is the market too high? I want to trim back and all this stuff. That's kind of music to my ears because the old saying is a bull market climbs a wall of worry. So when people come in here and they're worrying about the market, that's when I'm like, okay, that's a good sign. When people come in here and they are being like greedy about the market, I want to be in the market. That's when I'm like, maybe this is the end. But we're not seeing it in earnings. Earnings are justifying the valuations for the most part. Yes, there's some frothy areas, a term for it's kind of bubbly in the area. But as far as most people, I think staying invested, staying the course is the right answer. Um, if your risk tolerance has changed, if you feel like you are uncomfortable and it just doesn't meet your time frame, because really what you should be investing for is your time frame. So yeah, if you're not planning on taking large amounts of money out of your account anytime soon, it's best to ride through it. But if you're, hey, I'm going to be taking large sums of money in the near future, yes, that justifies, that really should be what determines if you are in or out of the market is your time frame. Anything you want to add to that, Blake?
Yeah, I would just like to double down on that sentiment that really your investment in the market shouldn't be tied to, oh, new high this or overextended that, but based on your specific needs and investment goals. And at WealthGuard Advisors, we're a registered investment advisor, and part of that is a fiduciary responsibility to our clients. And so we take that seriously to make sure we're specializing in managing your personalized asset management and financial planning designed around your needs and your unique goals. So if that's something you're interested in and would want to talk to us, we'd be happy to do a free consultation to see if we could be a good fit and help you avoid both the fear and the greed that comes along with watching market headlines.
If you have any questions, give us a call. We'd love to talk to you. Thanks for listening. We do this weekly, so please follow, like, share. Appreciate it. Have a great week.